Hey gang, it's 2019 and you're probably starting to get statements from December. It's going to be exciting. I want to talk to you a little bit about what to expect right now. All right, folks, so it's Friday. It is the 11th of January, which is always fun because, 111 and us numbers guys, we like that stuff. But we've started off 2019. It's actually been a really good start to the year as investors, as far as investments are concerned, because we're looking at S&P 500, Dow, NASDAQ, all the major indexes have been up. In fact, they've been up for like the last 5 days in a row at this point. So it's really been a pretty strong start. The problem is how we finished last year. Your statements are coming out right now, and what you're going to see is because the fourth quarter was really an aggressive pullback. Now, there are lots of indexes out there. The one that I want to focus on is the S&P 500. The S&P 500 had a peak value right at the end of September going into October, and it fell by at one point, as you measure intraday, it actually fell 20% from its very top to more than 20%. It just didn't close 20% down from peak to trough. So we don't get to technically call it a bear market, but it essentially had a bear market move in that third quarter. And it was punctuated on, of all days, a short trading day, but Christmas Eve. On Christmas Eve, we had a big drawdown, and that was the point where you measure from essentially October to Christmas Eve, and you go, wow, look at that pullback. So when you have a 20% pullback, that's the equivalent of having the tide go down. It takes everything with it. And there were not a lot of safe places in this storm, whether you were in fixed income or you were in the equity markets, whether they were globally or domestically. Everything was really kind of adjusting at that point. And a lot of it came down to the news from the Federal Reserve and the assumption the market was making that they were going to raise rates a lot. They have since clarified their statements, and it doesn't look like that's what's in the cards for us. So if the Federal Reserve is not likely to raise rates as aggressively, the market appears to be taking its time to reevaluate the data and breathe a sigh of relief. Here's the good news. Okay, the markets have already recovered a fair amount of what they've dropped. So by the time you get your statements, they're already wrong. There's a really good chance that your account value is higher than what you saw because the statement's printed at almost the worst time possible. Right? Almost as bad as it could look is exactly when they printed. So that's the first thing, is breathe a sigh of relief. It's probably not as bad as you think. The next thing is, economically speaking, the data still is pretty good. So we still appear to be in an economic expansion. We haven't gone into recession, at least not yet. The markets are evaluating the data, and so we always take it in stride. But from a long-term perspective, there's nothing that tells me the system is so badly damaged that we shouldn't be investors anymore. Certainly cautious. There are things that we're paying attention to, but I don't think it's time to throw your strategy out the window. And if you're looking at a statement, if you're not our customer, if you're somebody else's, I don't think you should go lynch your advisor just because of a rough quarter, because everybody suffered that, all right? But anyway, I just want you to be prepared for that. I still think as this first quarter emerges that we could probably claw some of those losses back from last year. I will keep in mind we had a really good a really good January last year as well, like a 7% move in January, and then February was pretty rough. But we're not looking at the same backdrop right now. If you consider if we get any kind of positive trade resolution with China, the Federal Reserve continues to be sort of steady and dovish in their monetary policy. And we do want to see how first quarter earnings start to shape up. And we're going to start seeing those coming up pretty quickly here. But we'll start seeing how are companies reporting, how are CEOs offering guidance for our economic growth down the road. As long as there's nothing too out of expectation, we'll probably make our way through this one, muddle along. We'll keep an eye on it, so make sure you like and subscribe to videos so you can stay in touch with them. Also, consider joining our newsletter because we don't always do this on video. Sometimes I will write and publish to our newsletter group. So go to the website and you can sign up for both of those, or we've got the links and stuff to find them. And as always, if you've got questions or other concerns, you'd like a personal review, something like that, don't hesitate to reach out and call our office at 541-375-0898. Otherwise, that's what I've got for this week. So hope you have a wonderful weekend. And also, keep in mind, or stay tuned, we're going to be rolling out something new coming up here. We call it Investment School. So we're going to actually break it down from the very basics. If you ever wondered, I have no idea what this guy's talking about, or anybody else, we're going to start from square one, the stuff that you never got in high school that wish you did, and we're going to start building from there. So we're going to take it in layman's terms and really break it down for you. Some of those videos will get longer, but I think they'll be worth it. So keep an eye out for Investment School. We'll be sending links for that as well. So get on the newsletter so you see it coming. Until then, thanks again for tuning in. This has been David Littlejohn. We'll catch you later.